Hello friends, you are once again welcome back to my channel. So today I want to briefly take you through what ICT dealing ranges are. This is volatility 75 asset pair, and I briefly want to take you through what ICT dealing ranges are. So if you are a trader of volatility synthetic pairs, you may watch this video, or if you trade currency pairs, you may have to watch this video to educate yourself on how you can use or how you can trade dealing ranges. Okay, so today's video is going to be brief and simple and quick, and then we move on to another session. All right, so quickly let's look at what dealing ranges are. So anytime we have one form of consolidation or the other, and then we have the market trading above and below it. Okay, so if we have a high and a low within a consolidation, okay, and then we have a market trading above it or below it, okay, we regard it as dealing range. Okay, so the high and the low that is formed after the market sweeps or takes the liquidity that is resting above the consolidation and the liquidity resting below the consolidation, the swing that is formed is what we consider as a dealing range. Okay, and it's a very good guide for you to see how and gives you a clear picture on how you can execute trades, coupled with all other ICT tools and all other ICT PD array metrics. Okay, now what are dealing ranges? So for instance, a typical example is what we have on the chart now. You have a market of this sort. Okay, you have a market of this sort, and there is this form of consolidation happening in here. Okay, so you have a market, you've had a consolidation happening all the way into this area. Okay, let me put this here. Okay, and then let me change mine. So we are taking this consolidation high, this as a high, and then we have a market that trades above it. Okay, price trades above this high and trades below this low. All right, from this high to this low forms our dealing range. This high to this low forms our dealing range, and necessarily we want to expect price to retreat or retrace back into the upper part, or the inverse will be the lower part. So for instance, in the case of a bearish market scenario, we want to see market retreat or retrace back into premium, and then we want to see price or the market taking orders around where we have either an imbalance or trade into an order block or trade into a bearish breaker. Okay, then we want to see it sell off. So with the dealing ranges, anytime we have some form of consolidation where price trade above it to sweep the buy side liquidity resting above it, and then intent trades below and takes the sell side liquidity resting below it, now we want to necessarily see price retrace back into premium to seek for more premium prices, and then we want to see a sell-off. Okay, so let me give you a clue in this scenario. So in this scenario, we had this form of consolidation happening, and then what happened next was price traded above this consolidation, formed this high in here, and then we saw the rejection. Okay, so price rejected from all the way and then traded beneath it. Now watch this. Let me close in my chart a little bit for you to see what I'm really talking about. Okay, so most of the time you're going to find these dealing ranges on the chart, okay, and it's going to guide you to execute your trade. So for instance, watch this. When we saw the price did this, necessarily from this high to this low, let's take 50% of our range from this high. Okay, so I'm considering just the bodies from this high to this low. Okay, so I'm using this the bodies of the candle. Okay, so from this high to this low, where is the 50%? 50% is right in here. And you notice when price got into 50% retracement level, it had to reject and then traded back down again. Okay, so beautifully you could see that it was right on the 50% level, just as a touch of the the, the 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 discount end of the premium side. Okay, I mean, when you take this whole premium, the lower portion of it, right as when it touched it, and then we saw the rejection back down. Price could have traded up into any level within in here before we could see the rejection down. Okay, but then beautifully we always frame our trades right in premium. Okay, and 50% is the premium. It's just crossing from discount into premium. Okay, from discount to premium, and then right as in here we saw the rejection. And then if you are even seeing the shift in structure happening on the 4-hour time frame in here, it just happened in here, and then we saw the retracement back in here into the breaker. Then the rejection continued. Okay, so now let's look at why price rejected, or when price got here, what are some of the premises, or what are some of the things to look out for to see that price has actually or price is rejecting from this level, and why it does that. Okay, so when we look at all this consolidation happening in here before the rally up, we could see that we have this low fruit hanging in here, this low fruit hanging in here. Okay, so we have 3 consecutive down close candles. Okay, this is the most recent low. Okay, this is this 3 down close consecutive candles. If we are looking for a breaker, okay, we have a low in here, or we have a high, a lower low, and then we have a lower high happening in here. Okay, so we have this down close candle forming our breaker. All right, or if you're going to look at the high that was formed just before this low, you can consider this high in here or this high in here. All right, so we have a high, a lower low, and then we have a higher high in here. Okay, so this forms our breaker. So we will consider these 3 down close candles as our breaker. Now when we take 50% of these down close candles, or when we pull a fib, you realize that the bodies of this candle beautifully respected the lower, or the upper part of this down close candle. So when we take 50% of this down close candle, which is somewhere around this level, okay, somewhere above this level, which is the discount, the premium end of this breaker. Okay, so price traded deep into the breaker, and you could see how beautifully price rejected, the bodies rejected from the breaker, and immediately price closes with this particular candle in here, with the body of the candle closing below this. Okay, at this point, then it gives you more perfect clue of the fact that price is going to rally down. Okay, good. So we see how beautifully the body of the candles, or the price, were rejected inside of this down close breaker. Okay, and then we saw price rally away from this price area. Now, besides the breaker that confirms for you that price is rejected from this area, and then we are seeing this happening, you could see that there was fair value gap resting here, which is an inverted fair value gap. Okay, now let's look at how that came in and then it played. Okay, so the inverted fair value gap is a fair value gap that has been traded through, okay, on the opposite side of the chart. Okay, so the inverted fair value gap, this is what happened. So price dipped just a little bit into the inverted fair value gap, and then touching the 50% level, we saw the rejection. Okay, So you would see that the body of the candles never even go close to the inverted fair value gap, and then we saw the rejection away from this area. Okay, so beautifully, this is one of the things you can see on a chart to frame your trades. Okay, these are some of the things you can see to frame your trades. So for instance, if you were not even sure around this area where we had this high, this low, and this high, and then we had a break. Okay, we had a break in the structure, or when we had the market shifted downwards, right beneath this breaker, you could have framed your trade around this area, and then you see you place your stop above this high. As beautiful as that. Now watch this. Price trades below this our dealing range low. Okay, it trades below our dealing range low, and then we see a reversal back into. So now let's pull our fib from a new high that has been formed, and then the new low that was formed. Okay, so you watch this. Right after the dealing range was formed, that you can see price is doing something beautiful in here. Okay, so right in here inside the 50% level, you can see how price is failing to trade above the 50% level. Okay, with the bodies of the candle, you could see how price is fully trying to reject from trading above it. And what is happening? We have this breaker also in here, that price is not trading above the breaker. Okay, price is not trading above the breaker with the bodies of its candles. You can see, if you consider the wick, price is fully rejecting as it trades into this breaker. All right, this breaker in here, and then we can see how price is fully rejecting it from trading above this breaker. And this is a clear sign. This is a clear sign of price not wanting to trade higher. The other thing to look at was when price traded in here, it went into this imbalance in here, traded into this imbalance, and then you see a rejection back down. Okay, so we are looking at price still being, price was in premium, and then we are looking at price trading beneath, seeking for more premium prices to run all the discount prices beneath this low. Okay, so beautifully, if you have framed your trade around this area, your highs, you frame your trade around this area, it's not a bad move you've taken, but we want to see price break beneath this relative equal lows hanging in here. Okay, we want to see price break beneath this relative equal lows to give us a clear depiction that price really wants to go lower. Okay, price really wants to go lower. So should price come back into this area, we're still not yet certain about executing a trade until we see price break beneath this low. If price breaks beneath this low, whatever gap it leaves in here, should price come back into, we want to give it a shot, and then our target will be the low fruit hanging in here. Okay, so after a dealing range, the next swing that it forms becomes the swing after the dealing range. So you want to wait for price to retrace above 50%, which is into discount, into premium, sorry, and then we want to seek for price to do either a rebalances, a gap, or it sweeps a high. But in this case, we are seeing this gap resting in here that price has rebalanced, and then we are seeing a breaker in here that price is failing to trade above it. So we keep our fingers crossed and wait for price to drop beneath this to show you that the market has shifted course. Then you engage the market. So beautifully, this is how to identify dealing ranges on volatility, synthetic pairs, and all other tradable asset pairs. Okay, so this is a short video for you. I wish you all the best in your trading, and see you in the next video.